Hey everyone, Barry Brooksby here with Insurance and Estates. Today we're going to be talking about splits, 50-50, 90-10, and life insurance policy design, the truth about cash value. What policy is best for you? You've probably heard of 50-50, 60-40, 80-20, 90-10. All these different designs simply mean how much base premium are you putting into the policy compared to the PUA? And honestly, this depends on your goals. Some of you want this new style, high cash value whole life insurance specifically designed to be used for infinite banking. Some of you want more of a death benefit play. You're looking at legacy planning, estate planning, asset protection. What would the Rockefellers do? Those are different types of policies. Either way, we can help you establish and get to your goals so that you accomplish whatever you foresee in the future. High cash value, more death benefit, any of those things that I've mentioned. For what we do at Insurance and Estates, we often see that most life insurance policies are designed backwards. There's too much premium going into base, not very much cash value growth, which means low cash values early on, high commissions for the insurance agent, and then there's not a whole lot of use for the banking strategy in a policy that's designed backwards or the wrong way. Today we're going to look at several different options, two companies in particular. These are the top two companies in the industry for maximum cash value growth. So let's dive into the numbers. All four of these illustrations are based on a $20,000 annual premium. The first one will be a 50-50 split, meaning 50% of the premium is going to base, 50% of the premium is going into PUA. So what we see here on total premium is the $20,000. This is a 50-50 design, and we want to look at total cash value. Year one is $9,453, and the death benefit over here is $745,000. Obviously, cash value is growing every year, but it's not growing as rapidly as a 90-10 design. Here's that design. Same annual premium, $20,000. Total cash value year one is $16,634 as compared to $9,453. Why is there more cash value? Because there's less death benefit. There's less money going into the base premium and more going into PUA. By lowering the death benefit, you get more cash value growth. As time goes on, there's considerably more cash value. I ran these illustrations from age 35 to age 60, 25 years of funding. Starting at the age of 61, there's no more premium going into the policy. You could continue to fund, but for our illustration purposes today, 25 years of funding, no more premium going in. You don't ever want to cancel a policy, but you can stop making premium payments in your later years or your retirement years. When you choose to stop funding, that's up to you. You do want to fund a policy at least 7 years for the MEC requirement so that all your cash value growth can be used tax-free. There are some other caveats to that, so be sure that you are getting good advice when it comes to tax-free future income, because there are some other things that you have to follow in order for that money to come to you tax-free. There are agents out there that are promoting to put more of your premium into base because there are claims that you'll have higher cash value, you'll be able to take out more future income, you earn more of a dividend. That's not completely true. As a matter of fact, what we're going to see today is that the 90-10 design will outperform the 50-50 design. So here we are, age 61, this is the 50-50, cash value is $1,011,000. But in our 90-10 design, notice that at age 61, the cash value is $1,054,000. And if we take this out to the age of 85, and this is just assuming you haven't done anything with the cash value or taken any money out. But at the age of 85, we see cash value is $3.5 million. Death benefit is $4.2 million. Well, what about the 90-10 design? At age 85, we're $3.7 million on cash value and $4.4 million on death benefit. So in the 90-10 design, you're getting more cash value and you're getting more death benefit at the age of 85. Early on, we saw that the death benefit wasn't as high in the 90-10 design. Again, your goals will determine what type of policy you want, but don't buy into, oh, I have to have a 50-50 split or a 60-40 split, because oftentimes those policies are not creating or giving you more cash value. And frankly, they're paying the agent more commission. You see, we as agents, we get compensated on base premium. The more base you put into your policy, the higher commissions we earn. Our focus at Insurance and Estates is to lower your base premium and maximize your PUAs, if that's what you want. If you're looking for a high cash value, infinite banking design policy, that's the goal, maximum cash value. Going back to what I said earlier about what would the Rockefellers do, you might want more death benefit. You might want legacy planning, estate planning, asset protection. That's a slightly different type of policy. Let's look at the second company to determine more information, more education around this subject. This illustration now is the second company. This is their 50-50 design. Net cash value is $12,300. This has more cash value than the other 50-50 design. Remember, the other 50-50 design was about $9,400 in first year cash value. This company has $12,300. But notice that the death benefit is lower too. And you'll recall, lower death benefit usually means higher cash value. Great cash value growth, but it won't be as strong as this company's 90-10 design. So now looking at their 90-10, cash value, $17,791 in year one. Death benefit is reduced even further to $336. This is because these policies have a term insurance rider added. The term rider raises the MEC limit so that you can get more cash into the policy. Some people might say, I don't want a term rider. But if you're looking for highest cash value growth, the term rider is necessary. It's that turbocharging of the cash value along with PUA. It's like adding a sail to the sailboat. It's going to give you more trajectory, more speed, and that's what we're seeing here with the cash value growth. Over time, cash value is growing phenomenal. You see very early on the cash value is growing by more than the $20,000 you're putting in. Starting at the age of 61, there's no more premium going into the policy. That's what that zero represents. Cash value is $818,000. Death benefit is $1.2 million on our 50-50 design. In the 90-10 design, we have higher cash value at age 61, $866,000, and $1.3 million of death benefit as compared to $1.2 million of death benefit. What happens at the age of 85? Age 85 on our 50-50 design, $2.1 million in cash value, $2.3 million in death benefit. How about the 90-10 at age 85? We're sitting on $2.2 million in cash and $2.5 in death benefit. So even in our second company's example, the 90-10 design, higher cash value and higher death benefit at age 85. A 50-50 policy, a 60-40 policy, a 70-30 may not always be right for you if you're wanting high cash value growth. If you're hearing out there that that's the type of policy that you should have, look at the illustration numbers. I've done this for 26 years. My focus is to help clients get as much cash value as possible, use the policies for infinite banking to go buy more assets, create additional wealth through investments, real estate, whatever you want to put money into. It could be a business or other types of investment vehicles. Maximum cash value you can see here in the 90-10s versus the 50-50s gives you more. And if that's what you want, The idea is higher cash value, 90-10. Now, not all companies have a 90-10 design, and not all companies are the same. You must be using a mutual A+ rated company that has paid dividends for 100+ years and that allows these types of policies to be put in place. There are many more benefits to this than what I'm discussing today. Not only tax-free use of this money, guaranteed returns, permanent death benefit, but you also can use the policies for collateral assignments with banks. You can increase your future income, especially from the tax-free position. Some of you might have concerns about funding premiums your entire life. You might want to put less than $20,000 a year into a policy. You might want to 5x this and put $100,000 or plus more into a policy. The premiums are flexible. When we design these policies for you, we naturally build in flexible premiums. But you always want to look at your own numbers. And this is going to matter to you because of your future. You plan today to have a better future tomorrow. Most people are taking income that's tax deferred or taxable. These policies allow you a future income that's 100% tax-free if done correctly. And you're allowed to use your cash value throughout your life to buy more assets to create more wealth. Look at your own numbers. Click the button below to learn more. We'd love to put illustrations together for you to meet your goals.